Benjamin Graham wrote a significant book on value investing. There is a ton of timeless wisdom in The Intelligent Investor. To quote Warren Buffett himself, by far the best book on investing ever written. Graham's masterwork is an application of Occam's razor, which removes all the unnecessary ambitions, distractions, and misunderstandings from the world of sensible investment. The knowledge that will last forever is all that is left. Graham's advice is simple in concept, but putting it into practice has proven to be a much more difficult task. Since its first publishing 65 years ago, everyone has had access to The Intelligent Investor's secrets. It's impossible to ignore the vast successes of the people who previously employed these tactics. However, his ideas haven't caught on with the masses. It's almost as if we can't help but hold on to the hopes and false beliefs that cause us to make poor financial decisions. If you're an investor, though, and you're prepared to put in the time and effort, and you can adopt Graham's perspective, you still have a chance to make money in the long run. Though business conditions may change, corporations and securities may change, and financial institutions and regulations may change, human nature remains essentially the same. Thus, the important and difficult part of sound investment, which hinges upon the investor's own temperament and attitude, is not much affected by the passing years. Introduction, page 24. Anyone interested in reading The Intelligent Investor should get a copy and thoroughly read it, which you can do using the link in the description of this video. Until then, here are some key insights from the book that you may use to evaluate your strategy for long-term investing. All quotations from Benjamin Graham's 1949 classic The Intelligent Investor are taken from the 2005 hardcover version. First lesson: cost and worth are not the same. Through our own investing activities, we have found that a company's intrinsic value does not change nearly as quickly as public equity prices might have one believe. It would appear that cost and worth are distinct notions in this context. We think Graham's comparison in The Intelligent Investor is the greatest one we've seen for understanding the significance of this finding. For this reason, we consider this to be the bedrock of any sensible long-term investment plan. When price and value diverge, profitable investment opportunities arise. So, let's say you spent $1,000 to buy a very little portion of a private company. Mr. Market, who is one of your business partners, is always willing to help. You'll hear his valuation of your stake every day, and he'll offer to buy it out or sell you more shares in the company based on that number. There will be times when his concept of value seems reasonable and is supported by the realities of the business world as you know it. On the other side, Mr. Market can sometimes allow his excitement or anxieties get the best of him, resulting in a proposed value that looks a little bit foolish to you. If you're a smart investor or business person, you probably won't let Mr. Market's daily updates influence your opinion of what your $1,000 stake in the company is worth. Unless you totally agree with him or are interested in making a deal with him. When his price is insanely high, you might be pleased to sell to him, and when it's low, you might be happy to buy from him. Most of the time, though, it's in your best interest to establish your own estimates of your holdings' worth based on the company's own complete disclosures on its operations and financial status. Page 32. These two paragraphs are the most crucial ever published from the perspective of a value investor. They condense the chain of events that validates value investing as a viable strategy for long-term capital growth. These statements, however, also have vital undertones when it comes to the idea of risk and the necessity of developing an investment mindset. Key concept number 2: risk is not the volatility of returns in the short term. When it comes to investing, many people equate risk with market volatility. Benjamin Graham, however, would not have made that connection. According to Graham, the only reason price volatility is important is if it allows an investor to buy shares at cheap prices or sell them at high values, using the Mr. Market analogy. In his words, even if a drop in the price of a security may be cyclical and transient, and even though the holder is unlikely to be obliged to sell it at such times, the definition of risk is often expanded to apply to such a possibility. However, we don't think this situation involves a real risk in any meaningful sense. We would underscore our opinion that the bona fide investor does not lose money solely because the market price of his securities decline, pages 72 to 73. And rarely will a serious investor need to sell his shares, and when he does, he can do it regardless of the market price. To the extent that it fits into his book, that's all he needs to do with it: pay attention and act. Allowing yourself to get stampeded or too disturbed by unwarranted market falls in your holdings is a surefire way for an investor to turn a basic advantage into a basic disadvantage. If his stocks had no market quote at all, he wouldn't have to deal with the emotional turmoil produced by the poor decisions of others. Page 40. Thus, according to Benjamin Graham, the concept of danger is primarily a psychological one. Thus, danger arises when an investor does not train his mind to resist being swayed by Mr. Market. Understanding number 3, you need to be mentally ready for success. Graham warns that investors face a substantial threat when they let their emotional and irrational tendencies influence their financial decisions, as described in his book The Intelligent Investor. Graham wrote during a time when investors were significantly less overwhelmed than they are today by news, economic projections, and others' perspectives. Still, he saw plainly that investors sometimes gave too much weight to data that turned out to be unrelated to the long-term performance of their portfolios. Successful investing hinges on having a healthy mental attitude regarding stock market swings. Page 21. Nearly anybody who cares about common stocks would like to hear someone else's prediction of what the market will do. The need being there, it must be supplied. Page 48. If a potential investor plans on making frequent purchases and sales, his weapons must be a distinct mindset and set of guiding principles that set him apart from traders and speculators. Values, not fluctuations in cost, must be his currency. To put it succinctly, he needs the mental fortitude of a genuine investor, not a phony speculator. Page 34. Graham's observations on investor psychology appear to be universal truths, as they are just as familiar to modern investors as they were to readers of The Intelligent Investor back in 1949. For example, in 2009, Jason Zweig wrote, "It's been stated that in order to be a savvy investor, one must be able to put their feelings aside. Actually, the opposite is true, you should feel emotions in the opposite direction." Having this kind of investment personality takes a lot of work, which could explain why value investing isn't more popular or successful. The fourth lesson is that it is impossible to know what will happen next. Although he thought, or we might say, knew, that companies' future earnings ultimately dictate their future market prices, Benjamin Graham was suspicious of investors' capacity to foretell the future. At best, predicting a company's long-term success is an informed guess. Some of the best educated estimates, coming from the most thorough research, have turned out to be abysmally wrong. In addition, the most intractable difficulty is the fact that if a company's bright future is obvious, it is almost certainly already reflected in the stock price, where it is often over-discounted. In the same way that betting on a big favorite in a horse race is a sure bet, purchasing such an issue is a sure guarantee that the issue will win. The possibilities may be on your side, but the true odds are against you. Page 14. Fifth, it's important to leave yourself some breathing room while investing. Considered in light of point number 4, Graham recommended purchasing enterprises at bargain basement prices in respect to their current catalogs of work. He reasoned that this would allow him to sleep better at night, which would increase his chances of success in the long run. An optimistic or pessimistic estimate is as good as any other, but even the relatively simple assumption that previous average earnings would be reproduced in the future may be deemed a more trustworthy basis of value. Page 127. The margin of safety principle becomes much more clear when we apply it to the field of discounted or bargain securities. By definition, this represents a situation in which the market price is lower than the value that has been established by some other means. The disparity represents the buffer zone. It can be used to mitigate the results of poor planning or unlucky breaks. Page 245. Buying companies at cheap prices relative to their past earnings has been shown to be a profitable investment strategy in the decades after the publication of The Intelligent Investor.